Good afternoon. This is Sean Golding with Golding and Golding, here to discuss a little bit about what Australians have to do when they're considered U.S. persons for tax purposes and they have assets, investments, income, accounts, etc., in Australia and other foreign countries. Let's jump right in. The first thing to keep in mind is who is a U.S. person for tax purposes. In other words, who has to file. And we're dealing with individuals, not entities. It's basically going to be three types of individuals: U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. U.S. citizen, even if you're born or naturalized; lawful permanent residents, whether you live in the U.S. or abroad; visa holders, even if you're on a temporary visa, if you meet the substantial presence test for counting days. If you are a U.S. person for tax purposes, then there's two main components: worldwide income. You're taxed on your income whether you earn it in the United States, whether you earn it abroad, whether you're living in the U.S. or whether you're living overseas. And global reporting, right? The IRS has various international information reporting forms that taxpayers have to file when they have foreign accounts and assets, etc. Some of the forms you may have heard: the FBAR, Form 8938, 3520, etc. There are some exceptions, exclusions, and limitations. We're not going to get too heavy into that, but if you meet the substantial presence test but you qualify for the closer connection exception, then you may not have to report worldwide income and worldwide assets. If you make a treaty election to be treated as a non-resident alien, then you may also derive that same benefit of not having to pay taxes on your worldwide income, just your U.S. sourced income, and you don't have to report the assets. Sometimes, other times you may. For example, FBAR. There was a recent case, ROS Day, where the argument is you shouldn't have to. Other forms, like the 5471, the IRS currently takes the position that you would. So when dealing with Australia, right, what are some of the common types of assets that taxpayers have to be aware of? The first one that you see all the time is a superannuation. When a person has a superannuation, and there's all different types, but I'm talking about your kind of basic, your uni-super, your Aus-super, not self-managed superannuations or public superannuations, which have different components to it. There's three main components, right? Contributions, growth, and distribution. So generally, if your employer, your Aussie employer, makes contributions to your superannuation, unfortunately, you don't get tax deferred treatment like you would for a 401k. Some countries, like the UK, it's in the treaty. The treaty between the US and Australia is woefully outdated, and so there's no component for the contribution deferral. Growth, distribution. So distributions, if you get a distribution, it's going to be taxable, right? Unless you're living overseas and you made the treaty election to be treated as a non-resident alien, or you meet the closer connection exception. But generally, distributions are going to be taxable. When it comes to growth, the general position most tax practitioners take is it's not taxable during the growth phase because it hasn't been distributed. Yes, the IRS can challenge that, but typically they don't. They like to challenge other things, like 25% tax-free distribution from a UK SIP, for example. But typically, if it's a treaty country and it's an employment type of pension, then they're not going to go after you for the growth. Now, if you do have self-managed super, it's a little bit different, right? Especially depending on who made the contributions, what type of accounts you have, is there PTY limited that you control, overseeing it, things of that nature. Another common investment type is just securities, equities, things like that. You may have a ComSec account or other investment account. The two main issues is going to be stock and funds, right? So for the most part, stock is going to be reportable and taxable. So let's say you have an account and you have stock and it accrued $2,000 dividends, it wasn't distributed to you, that's still going to be taxable. With funds, mutual funds, ETFs, that's going to be something called PFICs, which is passive foreign investment companies, which is a total and utter headache for taxpayers. But then it kind of depends on whether a QEF or an MTM election was made, whether the income was actually distributed, whether the distributions are considered excess distributions, etc., etc. But just know, if you have investments, accounts like stocks, funds, things of that nature, there's a high likelihood that there is a tax and reporting component. And of course, bank accounts, right? Bank accounts are reportable, and savings account, checking account, current account, any of those types of accounts. You report those typically on the FBAR and the Form 8938, which is FATCA, Foreign Account Tax Compliance Act, depending on whether you meet the threshold or not. We have a whole bunch of examples on our webpage going through the different types of accounts and assets and whether they're reportable and taxable. Excuse me. Some other common issues to consider with Australia specifically is the loan offset account. Okay, so let's say you have a mortgage account with $500,000, you have an offset account with $700,000, right? The income generated from the offset account, which is used to reduce the mortgage, is still typically going to be taxable from a U.S. tax perspective. It's being used typically directly to pay down the mortgage, but it's considered income from a U.S. tax perspective because there's nothing in the U.S. code that says it's not it's not taxable income. Another common issue is a zeroing out issue. So let's say you had $500,000 in a offset account, $500,000 in a loan account. Zeroes out, right? Does that mean you don't have to report it? No. Typically what will happen is when you have a mortgage type of account, even if it's negative $1 trillion, it's still going to be zero for reporting purposes. You don't go negative. And then the $500,000 account is reported separately as its own individual account. A lot of taxpayers in Australia may have a PTY limited either as part of their trust or maybe they have rental properties, small business, things like that. It is reportable for U.S. tax purposes. There may be income implications. A lot depends on the type of business that's being operated, how it's being treated. Does it qualify for disregarded entity status? Can you do an 8858 or do you have to do the 5471? Is it a controlled foreign corporation, et cetera, et cetera? But the issue to spot is if you have that type of entity, then it may be reportable and the income may be taxable from a U.S. perspective. Foreign gifts and trusts, it's also pretty common to receive large gifts from parents or relatives in Australia, or you may be the owner or beneficiary of a foreign trust. If you fall into those categories, the two main forms you have to file is 3520 or 3520A. Depending on whether you received a gift from an individual, an entity, or a trust distribution will impact the threshold if you have to file. If you're the owner of the trust, then you may have to report both forms. If this is all nonsense to you and you just learned about it, then you may be out of compliance, and there's various programs that you can use to get into compliance to avoid fines and penalties. If you're willful, then you do the voluntary disclosure program, but these days, especially, most people are not willful. There's various non-willful options available to you. There's the streamlined procedures, delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.